As we dive into the details, it becomes apparent that two significant themes have emerged from Michael Burry's recent moves: investing in regional banks and venturing into the realm of Chinese technology. These topics are undoubtedly thought-provoking and controversial. Let's begin by exploring Burry's investment in regional banks. During the first quarter, Burry purchased shares of various regional banks, including New York Community Bancorp, Capital One Financial, Western Alliance, PacWest Bancorp, First Republic, and Huntington Bank. Collectively, these acquisitions constituted approximately 24.26% of his portfolio. However, it is worth noting that due to unforeseen circumstances, particularly the downturn experienced by First Republic, this figure might currently stand closer to 22%. Therefore, Burry's primary objective is most likely to make a basket bet on regional banks in the US. By doing so, he aims to capitalize on the potential for a collective recovery. Considering the significant downturn these stocks have experienced, it is important to acknowledge that these investments do come with risks, given the current challenges in the banking sector. However, Burry's overall strategy seems to focus on the long-term risk-reward proposition and the attractive valuation opportunities available. Moving on to another significant aspect of Burry's Quarter 1 portfolio, let us delve into his increased positions in Chinese tech companies. During this period, he significantly added to his stakes in JD.com and doubled his position in Alibaba. These two stocks now hold the top spots in his portfolio, with JD.com at 10.26% and Alibaba slightly behind at 9.56%. This development is noteworthy because it marks a continuation of Burry's interest in these companies. By allocating a larger portion of his portfolio to JD.com and Alibaba, with a $10 million position in Alibaba and an $11 million bet on JD.com, Burry appears to be making a turnaround bet on these solid Chinese businesses. Both companies have witnessed substantial declines in their stock prices over the past couple of years. While China's overall economic growth has been sluggish and analysts forecast tougher conditions ahead, there are glimpses of hope in the financial performance of JD.com and Alibaba. Although complete recovery may take time, these companies have shown signs of improvement in crucial financial metrics such as revenue, gross profit, operating income, and net income. Another rationale proposed by some is that Burry's ownership of these stocks could serve as a component of a hedging strategy related to options, wherein he might be betting against the banks. However, this explanation also seems less probable, as put and call option positions must be reported alongside equity portfolios in quarterly filings. In this instance, there were no options bets reported by Michael Burry. As we continue to analyze Burry's move, it is important to acknowledge the complex and multifaceted nature of investment strategies at this level. Seasoned investors often engage in a highly customized game with their brokers, far different from the experiences of everyday investors like us. Although I don't have definitive answers, it is essential to consider the various theories and opinions surrounding Burry's regional bank investments. So, there are two main themes that stand out from Michael Burry's recent moves: investing in regional banks and increasing his position in Chinese tech stocks. These topics have generated significant controversy and discussion. Let us start with Burry's investment in regional banks. In the first quarter, Burry purchased shares of regional banks such as New York Community Bancorp, Capital One Financial, Western Alliance, PacWest Bancorp, First Republic, and Huntington Bank. These investments accounted for approximately 24.26% of our portfolio, although the figure may have decreased to around 22% due to the decline of the First Republic. Now, let us delve into the rationale behind Burry's investments in regional banks. It is a fascinating move considering the challenges faced by these community banks. While depositors are protected by the Federal Reserve, shareholders do not necessarily enjoy the same level of security. So, what is Burry trying to achieve with this strategy? While we can prove a definitive answer, we can offer an educated guess. Our hypothesis is that Burry is adopting a diversified approach by betting on a basket of regional banks. He likely believes that the current sell-off has been exaggerated, considering the significant declines in these bank stock prices, ranging from 30% to 90%. Instead of making a substantial bet on any specific bank, Burry chooses a broader strategy. He sees the risk-reward proposition favorably due to the extremely low prices across the sector. This approach is reminiscent of Warren Buffett's actions with airline stocks and his current involvement with Japanese trading companies. When it becomes challenging to identify clear winners within a group, making a basket bet on the collective performance can be a prudent move. Regional banks in particular are susceptible to the psychological nature of bank runs, making it difficult to predict which depositor base will panic and trigger a cascade of withdrawals. This theory aligns with Burry's statements on Twitter. In mid-March, after the collapse of SVB, he expressed his expectation that the banking crisis would resolve quickly and did not see imminent danger. This mindset suggests that Burry is indeed making a basket bet on the undervalued community banks. However, some analysts propose an alternative viewpoint, suggesting that Burry's investment in these banks could indicate a bet against them. For instance, an article from CNBC proposed that the shares he purchased could be intended to cover short positions in the banks. Shorting involves borrowing shares from another investor and selling them at the market price, with the intention of buying them back at a lower price to return them to the lender and profit from the difference. Short positions are not disclosed in 13F filings. While this scenario is plausible, it seems unlikely that Burry would hold shares specifically to cover short positions in his books. Typically, short positions are resolved immediately upon choosing to cover them. However, at this level of investing, the rules can be more customized, and unconventional strategies may be employed. Another explanation proposed by some is that Burry's ownership of these stocks could be a part of a hedging strategy related to options, wherein he might be betting against the banks. However, this explanation also seems unlikely, as put and call option positions are required to be reported alongside equity portfolios in quarterly filings. In this case, there were no options bet reported by Michael Burry. Furthermore, our assessment suggests that Burry is likely making a straightforward and diversified bet on regional banks in the United States. Despite the possibility of some banks failing, he perceives the overall risk-return profile of the sector as favorable due to the significantly depressed prices. This interpretation aligns with his previous statements on Twitter and resembles the basket bets made by Warren Buffett. Moving on to another significant topic, Burry has increased his stake in Chinese tech companies during the first quarter. He added 233% to his position in JD.com and doubled his investment in Alibaba. This development is intriguing because JD and Alibaba entered Burry's portfolio only last quarter. At that time, it was uncertain whether these positions were short-term plays, considering the relaxation of China's strict COVID policies in the previous quarter. However, Burry's substantial additions in quarter 1 indicate a potentially more long-term perspective. It is important to note that China's consumer spending and industrial activity grew at a slower pace than expected in April, with analysts anticipating tougher conditions for the rest of the year. Consequently, it might take some time for improvements to materialize in the Chinese market. While the overall stock prices haven't experienced a significant uplift, these positive signs provide a glimmer of hope for the future. And that concludes our analysis of Michael Burry's Quarter 1 2023 bets. But before we wrap up, let us not forget a crucial aspect that often goes unnoticed when examining his portfolio. It is easy to get caught up in an extensive list of buyers and assume that Michael Burry has become extremely bullish, believing the tough times are over because he is re-entering the market. However, it is essential to remember that when we consider his total portfolio size reported in the 13F, it is only $106 million. Comparing that to previous quarters, we can see that he had $165 million in the market back then. But that doesn't mean he lost around $60 million. He has kept a significant amount of cash out of the market, and it is likely that he possesses even more cash than the reported $165 million he had in quarter 1 of 2022. In short, Michael Burry isn't going all in on the market again. He's actually sitting on a substantial cash reserve, patiently awaiting more opportunities. This approach mirrors what Warren Buffett is doing at Berkshire Hathaway. While 13F filings provide interesting insights, we must remember the bigger picture. They don't reveal short positions, international equities, or cash positions. So, when interpreting this data, we need to put on our critical thinking caps. When we do that with Michael Burry's 13F, it aligns with the overall sentiment he has been expressing on his Twitter account, is still harboring a bearish outlook on current market conditions. We'd love to hear your thoughts and opinions on Michael Burry's portfolio in the comment section below. And if you'd made it this far, we kindly ask you to hit the subscribe button on our channel, Investing Path. We're striving to reach 1 million subscribers, and your support would mean a lot to us. Lastly, if you enjoyed this video, please leave a like. Thank you for watching, and we'll see you in the next one.